In the last video, we added our cart and our fixed assets into our budget. In the last video, we added our cart, our fixed asset, into the balance sheet. We realized that we didn't have enough cash to cover that, right? We had a negative $2,200 of cash, so we need to do something to fix that. A common solution is to raise some debt. So in this video, we're going to look at adding a debt amount that we're going to raise to counteract that. So to raise debt, we're going to have that coming in at period 0. We're going to raise $2,500, which will be enough to give us a positive cash balance. Now that debt amount is going to have an interest rate of 5%. So we're going to have both an income statement effect in our interest expense, then a balance sheet effect through the debt account. So let's start out by going to our balance sheet. We're going to make some room underneath current liabilities. I'm going to go ahead and make some room here for us for our long-term debt. Let's just copy our formatting again to kind of keep things nice and neat. And we'll call this long-term debt. And this will be total debt. So we're going to start out, we're going to link this to our long-term debt amount. And we'll talk about this second value in just a second. All right, so our long-term debt is linked. We have $2,500 of long-term debt. We want to make sure that that reflects on our balance sheet. So we need to add in our long-term debt account. Let's go ahead and select that, or our total debt, that is. So now our total equity and liabilities is our current liabilities, our total debt, and our total equity and our total equity account, or our retained earnings account. We can add those together. Let's copy that over as well. We can see that when that happened, right, our $2,700 of equity and liabilities was now equal to our $2,700 of assets. And our cash now, again, solved or plugged to figure out how much cash we have of $300. So we fixed our cash issue. So that's a good thing. Now let's look at our second period, or sorry, our second entry, or our end of the first period. In this case, like any balance sheet account, when we model it, we're going to set it equal to the prior balance, and then plus or minus any adjustments. So in this case, we're not going to add any new debt, and we're also not going to pay off any. Many times we think about debt as things like a mortgage, where you actually pay off the principal over time. A lot of corporate debt, though, is based on a balloon payment, where you pay interest only over time, and you pay the principal balance back at the end. So we're going to assume that. So the principal balance is going to stay exactly the same. And once we make that adjustment, we see another cash adjustment in year one, at the end of year one, in our balance sheet. So now our next step is to incorporate the interest expense. So here I'm going to come up to the top and make some more room in our income statement. Let's move this down a couple lines so we have some room. So I made one too many. Let's delete just a little bit there. Shift those cells up. All right, now we can add. Our first line is going to be EBIT. EBIT is often known as earning before interest and taxes, or I guess EBIT for short. So our earnings before interest and taxes is just going to be our subtotal here. And then we're going to go ahead and put in our interest expense. Our interest expense, this can be kind of a tricky one. And the reason it can be tricky is if we model our interest expense based on our current debt, we can end up with some circular references. Instead, kind of the best practice here is to model your interest expense off of the start of the period's total debt. Now, what's the start of the period's total debt? It's equal to the end of last period's long-term debt. So we can take that $2,500 of debt that we had at the end of the previous period, or the start of this period, and let's multiply that by our interest rate. So in this case, we have $125 of interest we owe. We can now update our net income to be EBIT minus interest, and we have $1,475. So now we can check that flowed through to our retained earnings. It affected the cash on our balance sheet, and now everything is tying back together, and we've incorporated the debt. We solved our cash problem, and now we can start thinking about a few more complexities in our financial statements.